Hey everyone! So let's talk about something that trips up a lot of investors: aggressive hybrid versus balanced advantage funds. They're both super popular, they both sound kind of the same, and that's where the confusion kicks in. Today, we're going to untangle all of that so you can figure out which one, if either, really makes sense for you.
Right. This is the big question, isn't it? On the surface, yeah, they're both just a mix of stocks and bonds. But underneath the hood, how they operate is completely different. The whole point of this explainer is to give you the confidence to answer that question for yourself. So, before we put them side by side, let's get to know each one individually. You have to understand how they're built to figure out how they're going to perform in your portfolio. First up, the aggressive hybrid fund. Now, if there's one word you need to remember here, it's fixed. These funds have a rule. They must keep a big chunk of their money in stocks, usually somewhere between 65 and 80%. The rest is in debt, for a little stability. But make no mistake, as the name says, these things are built for growth. And this chart really shows you what we're talking about. Look at that huge slice dedicated to equity. Because that slice stays pretty much the same size all the time, these funds act a lot like a pure stock fund. They're designed to really capture the market's upside when things are going well. All right, now let's meet our second player, the Balanced Advantage Fund, or BAF for short. And if the key word before was fixed, the all-important word here is dynamic. The fund manager isn't stuck in a narrow range. Nope, they have a ton of flexibility to move things around. And here's how that works in practice. The whole idea of a BAF is to adapt to what the market is doing. So when the market feels a little pricey or expensive, the manager can pull back on stocks, sometimes all the way down to 30%. But when things look cheap, they can hit the gas and ramp that equity up to 80%. It's kind of like having an automatic risk manager built right into the fund. Okay, so we've met both funds. Now we get to the big reveal, the real aha moment. This is the single biggest difference between them, and it's what drives everything else. So here's the bottom line. Aggressive hybrid funds are locked in. They keep a high, fixed amount in stocks no matter what the market does. They just ride the waves. Balanced advantage funds, on the other hand, are all about dynamic movement. They are constantly adjusting how much they have in stocks based on whether the market looks hot or cold. One is set on a path for growth, the other is designed to adapt along the journey. Okay, so what does fixed versus dynamic actually feel like for you as an investor? Well, it all boils down to a classic trade-off. Are you looking for maximum growth, or are you looking for a smoother journey? This table just lays it all out. Because aggressive hybrid funds are always heavy on stocks, they have the potential to give you higher returns over the long run. But, and this is a big but, it's going to be a bumpier ride with more ups and downs. Balanced advantage funds try to smooth out those bumps by adjusting their risk. The journey will likely be less volatile, but you might also miss out on some of the huge gains during a massive bull market. All right, now that you get the mechanics behind these two, let's bring it back to what really matters: you. This isn't about which fund is better. It's about which fund's entire philosophy fits your personality and your financial goals. Think of this as your personal checklist. You might lean towards an aggressive hybrid fund if you're okay with market swings, you've got a long time to invest, we're talking 5 years or more, and your main goal is growth. On the flip side, you might be a great candidate for a balanced advantage fund if you'd rather have a less stressful ride, you don't want to worry about timing the market yourself, and you like the idea of that built-in risk management. Now hold on, before you decide, I have to give you one really important warning. So many people fall into this trap of looking at last year's returns and just buying whatever did best. Please don't do that. Your choice should be about what you can stick with when the market gets scary, not about chasing what's already happened. If you remember just one thing from all this, let it be this right here. It sums it all up. Aggressive hybrid means you're signing up for higher potential growth, but also higher volatility. Balanced advantage means you're choosing a smoother journey with a fund that adapts for you. The right choice is always the one that lets you sleep at night. It's about you, not the fund. So I'll just leave you with this question to think about. Who are you as an investor? Are you the one who wants to be strapped into the roller coaster to get the biggest thrill, the biggest potential growth? Or are you the one who prefers a car with smart suspension that automatically adjusts for the potholes in the road ahead? Answering that is everything. And of course, I have to remind you, this conversation is for educational purposes only. Mutual fund investments are subject to market risks. Please consult a qualified professional before investing. Thanks for joining me.